And for that greater detail, we're joined this morning by Martin Smith. He's a portfolio manager at eNCA Capital. A very good morning to you, Martin. Perhaps let's start off with how the markets closed last night, which is on Tuesday, and what we can look forward to when the markets do open today.
Yeah, like you've just mentioned, we saw a lot of red in the market yesterday. You've seen continued pressure, mostly around fears of high interest rates for longer in the States, and obviously that kind of affecting global markets, and fears of a global recession starting to creep in again. So if you look at that, coupled with the fact that the US market was down significantly last night, Asian markets this morning also very much in the red. I think unfortunately it's going to be a bit of a bad start for us this morning.
Let's take a look at the South African rand. It's a much weaker rand. What are the immediate implications for South Africa as an emerging market?
So I think if we look at the rand, it's more of a dollar story, actually. The dollar is very, very strong at the moment. Again, coming back to fears around recession, fears around interest rates staying high for longer. So the dollar being a natural safe haven asset, even more so than I think something like gold. You've seen the dollar strengthen significantly against other currencies, specifically emerging market currencies in South Africa, with their rand being the most kind of liquid emerging market currency and very much a proxy for emerging markets. It's taken a lot of that on. Obviously, implications are higher inflation, specifically if you couple that with an elevated oil price. So from our perspective, it could be interesting, potentially bad news from an interest rate perspective.
You rightly mentioned the stronger dollar, the fact it's actually more about the stronger dollar than the weaker rand. As far as the strength of the dollar is concerned, what are the factors that are actually affecting its performance? And if I have to ask you to look into your crystal ball, when and for how long do you see this persisting?
I mean, that's the golden question, right? So I think if you look at the dollar, I mean, historically you were getting next to nothing for kind of cash in the bank in the States. Now you can buy long-term bonds in the States for kind of getting 4.5% to 5% in US dollar terms. So there's a lot of appetite to go into something like that, specifically when you've got real concerns about what the world is doing and how long inflation will continue and interest rates will be elevated for. So how long? I think if you asked economists a year ago, they would have said by now things would have kind of alleviated. But I think second half of next year, we'll start to see that interest rates in the States will start to go down. Potentially, we'll see and then see some kind of appetite return. So it might be a while, probably next 6 to 12 months is my best guess.
Let's take a look for a moment now at Pick n Pay with the returning CEO. Can he stage that very much needed turnaround that's needed within Pick n Pay?
Well, I mean, that's what shareholders are hoping for. And if you see the results that they put out, or sorry, the updating trading statement that they put out and the share price reaction, it shows that they weren't very happy with the results that came out and the numbers that we've been putting forward. So very disappointing and very well below kind of consensus. Look, the CEO that comes back in, I mean, he was there from 1999 to 2007. So the retail landscape has changed quite a bit. But yeah, it remains to be seen what he can do. We've got results from Pick n Pay next week, Wednesday. So we'll have a little bit more detail and we can see what he says thereafter.
Our New Park trading update, the property company is expecting the environment to improve and tenants to stop defaulting on their payments, given their portfolio. Is it what the market anticipates as well?
So, I mean, for property companies at the moment, or any kind of REIT, it's been a very, very difficult period out there. As we're well aware, higher interest rates, constrained consumers, constrained businesses. So it's been very difficult, and you've seen them take a bit of a hit, and some of them halting their dividends and their distributable kind of income to shareholders. So that's at least positive from them that they've mentioned that they are seeing an uptick of it. Obviously, they've got properties in Sandton and the JSE building itself. So we'll see if that filters through to their share price. But again, you are seeing pockets of recovery in property counters, specifically after the hard times that they saw kind of in a post-COVID world. So it remains to be seen on that one.
Now, we're seeing the secondary listing of TFG on the A2X. What opportunities does this unlock for shareholders?
So I think if you look at this kind of secondary listing, I think it's more a function of providing a second access point to shareholders to buy into the share itself. I don't think it's going to be materially or anything material from a shareholding perspective or from a price perspective. The secondary listing, again, it's just a secondary access point. If you look at something like Anglo Gold listing on the New York Stock Exchange, where they were getting potentially higher multiples and access to kind of offshore investor capital, that's a different story. Here, it's just about providing shareholders another access point to buy the shares.
Martin, thank you so much for today's update. That was Martin Smith, Portfolio Manager at eNCA Capital.